Hey, good morning and welcome to the conference. We're so excited to have you guys here today and to join us on this stage for what we think will be a very interesting conversation around the insurance space, the Insurtech space, and the VC space. So just by way of introduction, my name is Andrew Daniels. I'm the founder and managing director of Insurtech Ohio. And the topic today is really around solving for industry problems with a fresh perspective. So by 2028, global Insurtech expects revenue growth upwards of $61 billion. And this is driven by the need for digitization. This problem still exists and provides a lot of opportunity still for entrepreneurs to get involved in the industry. Despite Insurtech having such a large and active sector, problems like this are still existing out there and still need solved with technology. So with me today, I have Matthias Weber. Matthias is a venture partner at Mighty Capital, and I think you guys will find this conversation really interesting. So welcome, Matthias.
Thank you, Andrew.
Yeah, so you have a very unique path to venture capital and Mighty Capital especially. Tell us a little bit about how you got here. What have you been doing this whole time, and how did you get into the VC game?
Okay, well, maybe it makes sense if I quickly talk about what I did before Mighty Capital. So thank you for the question. You probably have realized by now that I did not grow up in Brooklyn, based on my accent. And if you thought so, you are absolutely right. I grew up in Switzerland. I was born and raised there. I studied physics at the ETH in Zurich, did a PhD. And after I finished the PhD, I realized I would like to do something else. And the reason is I liked physics, but I did not love it. And what I missed a little bit is let me say, the impact it has on people and on society. It was challenging, but I never thought it has a huge amount of impact, at least not what I did. And so I looked around for something that does have impact, and believe it or not, I thought of insurance as something that has impact on the daily life. And Switzerland being a small country, there are some insurance companies in Switzerland, but not too many. And at that time, Swiss Re, which is the world's second largest or largest insurance company, it depends a little bit how you count, they were looking for a hurricane specialist. I did not know how to spell hurricanes, and I did not really know a whole lot about insurance either, but I applied and got the job. Given the fact that I was a scientist at the time, they put me into a research department. I contributed to the development of the first generation of Swiss Re's NatCat modeling tool. In addition to that, I was also part of the team that issued the very first insurance-linked security of Swiss Re it was in 1997. And after approximately 5 years, I felt I needed to make a change. By the way, that's a theme in my life. After 5 years, I need to do something differently. But I liked Swiss Re, I really did. So I was looking for other opportunities within Swiss Re. And I had two great opportunities. One was, and at the time I was in the mid-30s, become the chief underwriting officer of a small subsidiary of Swiss Re. So great title, great responsibility, but a small pond to swim in. And the other was go to the United States and do exactly the same thing I did before in Zurich. And going to the US has always been my dream. So being a scientist, I approached it kind of systematically, listed all the criteria that matter for decision making, allocated points for each of the two options, added up the points, and it was a tie. So it didn't help me at all in the decision making. So I allocated weights for each of the criteria, multiplied the points with the weights, summed everything up, and it was 79 to 80. And I was smart enough to realize that this is not good enough, and I decided to do it again the next day. And the next day it was 81 to 80, and the clock was running. I had to make a decision. And decision making, I found it hard. And then on a Sunday morning, I was in the shower, I was whistling a song, and it was, "Good morning, America, how are you?" And then I said, you know what, that's it. I'm going to the US. And I called the other opportunity off. I signed the paperwork to go to the US. And 1 week later, it was announced that the other small subsidiary was shut down. So my job would have gone. And the reason why I'm sharing this with you is technology is about data, it's about algorithms, it's about model, it's about doing the analysis. But in my opinion, it needs to be combined with experience of people, with the human element, with common sense, in order to really fully unleash the power of technology. So I thought that's a nice example. So short of the long, I moved to the US. I had a good career at Swiss Re, 25 years long, both in the US and in Switzerland. I had several positions during this career. I ended it in 2017 as the Group Chief Underwriting Officer of Swiss Re out of Zurich in order to be able to move to the US. My wife, I got to know her in the US. She was from California, and I promised to her, once I retire, we will move to California, and that's what I did. So I was in Silicon Valley, too young not to do anything at all professionally. I'm not a great golfer. I have been traveling a lot, so I decided to continue to work. I became advisory board member or corporate board member for a number of companies. Right now, 5 companies in total, 2 of them board memberships, Next Insurance and CyberCube Analytics. And in addition to that, I went to Stanford University to invest a little bit more in my own education. I always liked going to school. I probably just passed a nerd test, right? But I went to Stanford, and there one of my instructors was S.C. Motti, who was in charge of Mighty Capital. And after one class, she asked me whether I would like to become a VC partner at Mighty Capital. And I said, yes, of course, that sounds interesting. And here I am talking to you as a representative of Mighty Capital.
Yeah, so that's interesting. I think you did pass the nerd test, right? You talked about putting together a scorecard for making a job decision, which you then took several times before you made that decision. And then you went back to school. So tell us a little bit about Mighty Capital. I think that's an interesting transition for you, coming from the insurance industry and this expertise to kind of a whole different world, but maybe there are some similarities there.
Sure. So Mighty Capital is a relatively young VC fund. Mighty Capital was founded in 2017. They made the first investment in 2017, and the second was already in 2018. Check sizes are between 1 and 5 million today. At the beginning, it was a little bit smaller. Mighty Capital is now in the second half of Fund 2, meaning they are fundraising already for Fund 3. So far, they have made 23 investments. Of the 23, 3 have IPO'd. Amplitude, DigitalOcean, and company you probably all have heard of, Airbnb. So Mighty Capital invested in them. Mighty Capital focuses on technology, healthcare, and fintech slash Insurtech. That's why SE asked me whether I could join her firm. And when you speak about the VC, it's always important also to explain what makes a VC different from every other VC. Because they all have capital and they all have good-looking people who are smart with connections and network. And so does Mighty Capital. What makes Mighty Capital different is there is an organization of product managers. It's called Product That Counts. And this network is run, guess by whom? SC Moati, who is also the MP of Mighty Capital. So as a result of this, Mighty Capital has unique access to this network. It consists of 300,000 software product managers worldwide. 80% of them are in the US, 20% are outside of the US. And what Product That Counts does is they provide content, they arrange events, and the senior product managers, the successful ones, they share their insights. And now the link to Mighty Capital, we give our portfolio companies unique access to this network. So a portfolio company that thinks having a good product is important to success finds it is sometimes hard to find good product managers because everybody is looking for them. Well, we have 300,000 to choose from, or to give to the entrepreneurs to choose from. Entrepreneurs also like to sell into the network if they have a corresponding product. We typically pair them with a mentor from the network to give product-related advice. And last but not least, at the end, when the time is right, we use this network also to initiate an M&A discussion.
Yeah, I think that's great that you kind of went down that path because you first talked about how much capital you like to invest in those companies, but spent more time on the value that you bring as an investor. Obviously, that's really important, and founders learn that as they go through cycles of fundraising. That you can get the money. The money is helpful to build the business, but the networks and the relationships that the VC brings are more important sometimes than that money. So maybe tying back your experience to Mighty Capital now, how do you use that kind of data-driven experience in the underwriting side of insurance in Mighty Capital now? Like, how does that translate?
Okay, so when I was at Swiss Re, I did several jobs at Swiss Re, but most of the time technical jobs, including underwriting. I probably 60% of my career at Swiss Re I spent in underwriting. And I started relatively junior and I made it all the way to the top within the underwriting organization. And you are probably fully aware of it. What underwriting is about is an underwriter is presented with an insurable risk. This could be an individual policy, or it could be a portfolio of policies if the underwriter works for an insurance company. and the underwriter makes a risk-return decision. The underwriter looks at data, does some math. The underwriter assesses people, the quality of the team involved. And the underwriter also tries to look into the future, which, as you know, is incredibly hard. But the underwriter tries to identify relevant trends for this specific insurance opportunity in order to answer the question, will it be a good insurable risk? Will it be a good risk in the future? Now moving over to the investment side, what Mighty Capital is doing, right? We don't have underwriters, but we have a team of people who engages in due diligence. And what the due diligence team does is they look at data, they do some math, they assess the people, super important, right? Especially for early stage company. And they analyze and identify forward-looking trends in order to decide, will an investment in a specific underwriting, in a specific early stage company, will it be good in the future? So while the data to be analyzed are different, while the analysis itself is different, the people are certainly different, and some of the relevant trends might be different as well, the overall approach to make this type of risk-return decision is actually quite similar. And that puts me in a situation where, on the one side, you could absolutely honestly say, I'm relatively new to the investment world, 2 years in total, and I would say, yes, you're right, totally, that's correct. But you could also say, I'm not new to making risk-return decisions at all, and that's probably true as well.
Yeah, that's it's really interesting thing to think about as VCs are looking through these lists of companies and different data sets and trying to figure out which ones they make investments in. It is I've never thought about it, right? It's very similar to the underwriting process and the data-driven stuff there too. So maybe you mentioned a little bit earlier about your advisory and board work with some of these Insurtech startups too. Maybe some learnings from those as you've kind of seen the first wave of technology and startups come through this space. What have you learned, or what have you seen that you can help the next wave of startups coming through with?
Well, quite frankly, given that I'm new to this, still relatively new to this world, this also means I'm in the steep part of the of the learning experience. So I'm still learning a lot, and I hope to learn also a lot at this conference. But one of the things we have seen when I started to engage myself with Insurtech companies, it was a lot about growth, right? And it's still about growth, ARR growth, mostly. And that was a little bit strange to me, because coming from the traditional insurance world, I learned and had the experience, made experience, and also had the mindset that growth is super important, right? But growth is a means to creating bottom line. And as such, growth without the bottom line is worth nothing. Bottom line is everything, and you need to have growth in order to be able to create a sizable bottom line. That was a little bit my mindset. And in the Insurtech space, several years ago, it was just about growth, and it was not about loss ratios, right? And I looked at some of the loss ratios, which were maybe even triple digit. And I thought, well, it's great for consumers, but is it great for the investors? But I also felt, okay, they probably know what they are doing. But I was always putting a little question mark behind it. And then I realized that over time, the mindset has changed a little bit, right? And today I would say there is agreement that growth continues to be important, but there is also agreement that unit economic matters, right? And in Insurtech, especially for the full-stack digital insurance companies, if they have loss ratios in the triple-digit range, that is the equivalent to a SaaS company with a negative gross margin, right? And investors probably would not like it too much. And this mindset has happened. I was able to observe it, and maybe I contributed also a little bit. I hope I did. And in my opinion, that's a very, very healthy development. Maybe another thing, if I could mention, in 2017 when I started, I heard a lot. Okay, the word disruption and there is no space for the agent in the ecosystem. Everything was about D2C, direct to consumer. And the companies had some success, but some people, you know what, they wanted to engage with agents. And over time, the Insurtech entrepreneurs, they realized, well, it's about putting the client, the ultimate consumer, into the middle. And if the ultimate consumer wants to engage with a human who provides some advice, let them do it. So today, if you ask probably any Insurtech companies, they would say, and that was different from 2017, they would say, you know what, the client decides how to buy insurance. If a client wants to do it through a website or the mobile phone, that's fine. We will offer it to them. However, if the client wants to talk to an agent, that's fine too. And therefore, some Insurtech companies also provide technology in order to make the agents as nimble and as quick and being able to provide a fantastic client experience to their clients. So that's another change which I have observed.
Yeah, you seem to see that maturation process now where the new carriers coming up are already engaging those channels early on too. It really is this omni-channel approach because now there's technology built to distribute in those areas, which wouldn't have happened without the first wave trying to do it themselves, right? So maybe keeping on that, let's talk about trends in the Insurtech industry. What are you seeing out there? You're seeing, startups and companies, and from a board perspective too. What's out there? What's piquing your interest from that perspective?
Well, what I have not yet seen, if I start with this, is companies who are selling insurance in the metaverse. And what I also have not seen is company who are insuring NFTs. I don't know whether it will come eventually, but that does not yet exist, and maybe it's not a good idea at all. That's actually
well. That's the second time the metaverse has come up today. I think in earlier.
Maybe metaverse. There is a metaverse, right? And if you ask my two boys, Alex and Nico, they would say super important. You need to engage there. It's probably also a matter of age, a little bit. But I think the most interesting trend right now to talk about is, right, cycle. You probably all know the insurance cycle, right? Sometimes premiums are so high that the loss ratios are very low. That attracts additional capital, additional competitive pressure, premium levels drop, loss ratios increase until the loss ratios are so high that they destroy the capital, and then premiums go up again, etc., etc. So that's a well-known phenomenon, the insurance cycle. Everybody knows about it. Everybody says we will work hard to make it go away. It will not go away. I'm telling you this from my experience. On the investment side, there is a similar type of cycle. The investors call it the risk-on, risk-off cycle. There are times where the macro trends appear to be benign and not scary, and during these times, investors tend to gravitate towards more risky investments because they have a certain risk tolerance. And then there are times where the opposite is true. The macro trends look really uncertain and scary to most of the investors. And then the investors tend to gravitate a little bit more towards safer investments. And right now we are in such a period, given Putin fighting a war in Ukraine, given where the inflation is, given where the interest rates are. Corona is still out there, right? It's not as scary as it used to be, but it's still out there. So investors have become a little bit more risk averse, and that's also true for angel investors and VC investors and PE investors, those who are actually normally not shying away from accepting risks. And that, of course, makes it a little bit tough for entrepreneurs who need to fundraise, and they need to fundraise fairly frequently. And because right now it just takes a little bit longer because the investors absolutely want to make sure that it all makes sense from their perspective. As a result of this, the valuations are a little bit lower than they used to be, and the dilution is a little bit higher than what was the case. So this is happening right now in all type of verticals. The reason why I'm spending a little bit of time on this is within the Insurtech world, there is a class of company, the full stack digital insurance companies. So those Insurtech companies that are actually competing with other insurance companies that need capital not only as working capital, not only in order to finance a period of negative cash flow, which they all have initially, but also for regulatory reasons. So they need a lot of regulatory capital in order to back up the insurable risk they write. And this is typically the biggest amount of capital of all the three. And that makes it right now, especially for the full stack carriers, a little bit tough. And I'm sure some of the early stage companies who are here probably feel the same and would agree with this.
Yeah, well, I've also seen a lot of companies in the kind of pet travel, these kind of niche, smaller coverages. Recently, it seems like it's getting a little crowded. What do you think about those kinds of coverages and the space there?
Well, it's actually a very interesting point, right? If a space is getting crowded, that means there is sufficient business to be made there, and there are a sufficient amount of people who think there is a big problem to be solved, and there are solutions that could be tailored to address the respective problems. And I think that's all true. However, if you allow me, I would like to offer here an additional thought. What I'm missing a little bit, right, when somebody is offering embedded insurance, for instance, pet insurance, right? You buy a dog, you buy pet insurance or travel insurance similar. For me, and maybe I'm a little bit influenced by my experience and my background, buying insurance is and maybe should be a strategic decision, right? Most people who are married like I am, with 2 children, so a family of 4, if you buy personal lines insurance for a family of 4, depending on where you live and your ages in your family, that can cost easily 30,000 per year, including health insurance. Most families actually cannot afford to pay 30,000 in a given year. However, they can afford 6,000 or 10,000, a smaller amount. And then, in my opinion, it should be a strategic decision. If all insurances that I could buy cost 30,000, but I can spend only 6,000 per year, what should I buy? Should I buy car insurance beyond the minimum I'm forced to buy anyway, because it's a statewide requirement? Should I insure the home? Should I buy life insurance? Should I buy health insurance? Should I buy disability insurance? So that should be a strategic decision. The boundary condition is how much money you can spend. And what you want to optimize is make sure that it has the biggest and best possible financial impact for you and your family. And that's actually not an easy decision. And interestingly enough, so far I have not met too many companies who think that is a problem and maybe an opportunity to address, hint, hint. And the reason why I wanted to speak about this briefly is sometimes I feel these spontaneous buys. I travel somewhere and I buy travel insurance because I take a flight are not as strategic as I would like them to be. Sorry, it was a long answer, but
that was perfect. I think you highlighted another gap beyond the metaverse that is there. Are there anything else? If I'm a founder out there looking for an idea in the insurance industry or a problem in the insurance industry to solve still, are there any other gaps out there that you see that need addressed?
I would like to share with you a little story about my family. So my older son, Alex, when he was approximately 5 years old, he asked me once, "Hey, Papa," he calls me Papa, "when you go to work, what do you do at work," right? And I was the head of property and specialty insurance at Swiss Re, an insurance company at the time. Of course, that didn't tell him anything. So I was struggling a little bit, and I tried to buy some time and said, "Look, I'm in meetings, I'm traveling, and I'm on the phone a lot." And I was able to buy 3 seconds. And then he followed up and said, "But when you're in meetings, what do you talk about?" So he really wanted to know. At that time, he could count to 1,000. So I said, "Okay, imagine there are 1,000 families like our family, and they all have a home, and one home, unfortunately, burns down. Imagine a world where the other 999 help this poor family who lost the home to rebuild a new home, and they pay for it." And that's what insurance is about. And being in the insurance industry, I help arrange this. And when he heard this, his eyes got big, and he said, "Hey, Papa, that's really, really nice of you." And of course, that's 5-year-old speak for saying, "I think insurance has a great value proposition." And I would agree with him, insurance has a great value proposition. But insurance has a little bit a lackluster reputation. By the way, it's not a horrible reputation, but it's not a great reputation either. So lackluster is probably the best word. And in my opinion, there are 2 reasons. One is premiums are too high, That's reason number one. On the P&C side, if you buy insurance, you typically get 60% of the insurance premium back in the form of losses. If I approach you and say, hey, could you please give me $100 today, and over the course of the next 10 years, I pay you 60 back, I'm not sure you think that's a great product. So the maximum permissible loss ratio should be higher. And this requires less manual efforts, lower frictional costs on the insurance side. And the second thing is the second problem that needs to be addressed, and I see we are running out of time, but I will get it in, I promise. The client experience when buying insurance is not that great, right? Nobody wakes up in the morning and says, what a great day, today I'm buying insurance. And of course, it's also a little bit linked when you think about insurance, you think about what could go wrong in life or what could break. And that's not necessarily a positive thought. But in addition to that, the insurance products are sometimes a bit complicated. The policy wordings are not always easy to understand. People like insurance products from different carriers, as a result of which they are not perfectly well aligned. So there are a number of problems to be solved related to client experience.
That's great. I think that's a great way to wrap up the conversation. There's still problems to be solved, and some of them are simple, right? Just that digitization and that customer experience and things like that. So really want to thank you, Matthias, for the conversation today. Hopefully our audience enjoyed this as well. If you're a founder out there looking to connect with VCs, Matthias is here today in person. If you want to chat more about data, or if you're thinking about changing your job and need a scorecard for understanding if you should change your job or not, Matthias might have a scorecard for you too. So thanks for joining us. Please stick around here in the next 10 minutes for our next panel called One Platform at a Time. We'll have some great speakers here for that panel as well. Thank you so much for your time.
Thank you, Andrew. Great question.